Picture a trading floor in lower Manhattan on a spring evening in March 2000. The sun has set over the Hudson River, but the room it is still alive with flickering screens. Green numbers cascade down terminals. Young traders in loosened ties lean back in their chairs, watching stock tickers that seem to only know one direction, up on one screen. A company that sells pet supplies online has a market value larger than some automobile manufacturers. On another, a website that delivers groceries is worth more than supermarket chains that took decades to build. A firm that simply added .com to its name saw its stock price double in a single day. How did we arrive at a moment when a website with no revenue could be worth billions? Why did experienced investors, people who had studied balance sheets their entire careers, suddenly decide that profits didn't matter anymore? What made this particular bubble different from all the manias that came before it? And perhaps most importantly, for those of us thinking about our own portfolios today, what can we learn from the moment when the future arrived too fast and too expensive? A word to the listener. If you're listening to this now, you might be settling in for the night. Maybe you spend your day watching markets, reading financial news, checking your portfolio. Maybe you're thinking about Bitcoin, about AI stocks, about the next big thing, or maybe you just need your mind to slow down after a long day of work and decisions. This story isn't designed to get your heart racing. There are no secret trading strategies here, no hot tips, no promises of overnight wealth. Instead, this is a story about time, about how investors in the late 1990s convinced themselves that time itself had changed, that old rules no longer applied, that patience was for people who didn't understand the revolution happening before their eyes. It's a story about what happens when everyone believes they're early to something that's already too late. And it's told in a way that lets you rest, lets you think, lets you drift if you need to, because the best investing lessons are the ones that settle into your mind slowly like snow falling on a quiet street. The world before the bubble. To understand how the bubble formed, we need to go back to the early 1990s. The Cold War had ended. The United States economy was recovering from a recession. Personal computers were becoming common in offices and homes, but they mostly sat alone, disconnected islands of spreadsheets and word processors. Then something changed. The internet, which had existed in universities and government labs for decades, became available to ordinary people. At first, it was slow and clumsy. You dial into it with your phone line, listening to strange electronic squeals and beeps. Websites were simple, mostly text, often ugly, but even in that primitive form, people could sense something profound was happening. Information that used to require a trip to the library could appear on your screen in seconds. You could send a message to someone on the other side of the world instantly and for free. You could theoretically start a business that reached millions of people without ever renting a storefront. The technology, emerged at a fortunate time for investors. Interest rates had been falling through much of the 90s. The Federal Reserve, led by Alan Greenspan, had managed to keep inflation low while the economy grew steadily. Corporate profits were rising. The stock market, measured by the S&P 500, had been climbing for years. People who had been cautious after the 1987 crash were starting to feel confident again. And then they saw the internet, and they saw, or thought they saw, the future. The first believers, not everyone believed at first. In 1994, most serious investors still focused on traditional measures of value. They looked at earnings, at cash flow, at tangible assets. They had annual reports. They calculated price to earnings ratios. They believed that a company should eventually, someday, somehow, make more money than is spent. But a small group of visionaries and entrepreneurs started creating internet companies with a different philosophy. They argued that the internet would change everything, would remake commerce itself in this new world. They said the important thing wasn't profit. The important thing was growth, market share, mind share, being first. The logic went something like this. The internet would create winner-take-all markets. Whichever company became the dominant player in online books or pet supplies or auctions or search would eventually own that entire category. So the goal wasn't to make money today. The goal was to grow as fast as possible, to acquire as many customers as possible, even if you lost money on every single transaction. Once you dominated your market, once you were the default choice for millions of users, then you could figure out how to make a profit. Then you could raise prices or cut costs or introduce premium features. The money would come later. First, you had to win. This strategy required enormous amounts of capital. You needed money to build websites, to buy servers, to hire programmers and designers. You needed money for advertising, so much advertising everywhere. Super Bowl commercials, banner ads, billboards, sock puppet mascots, and you needed money to keep operating while you lost money on every sale. Where would all this capital come from? From investors, of course, from venture capitalists in Silicon Valley who had made fortunes backing earlier technology companies, from Wall Street banks eager to take these companies public, and eventually from millions of ordinary Americans who were starting to believe that the future had arrived when Netscape went public, the moment that many people point to as the beginning of the bubble happened in August 1995. A company called Netscape, which made a web browser, went public. The company was less than 2 years old. It had never made an annual profit. On the first day of trading, the stock opened at $28 per share. And by the end of the day, it had reached $58. The company was suddenly worth nearly $3 billion. Mark Andreessen, one of the founders, was 24 years old and worth more than $100 million. Wall Street took notice, so did Main Street. Here was proof, dramatic and immediate, that internet companies could make people wealthy beyond imagination and fast. You didn't need to wait decades for a company to mature. You didn't need steady earnings and conservative growth. You just needed to be part of the internet revolution. Over the next few years, the pattern repeated again and again. A young company with an internet-related business would go public. Investment banks would promote the offering. Demand would be overwhelming. The stock would soar in the first day, often doubling or tripling. Early investors would become millionaires overnight. And the message seemed clear: get in early or miss out forever. The mechanics of the mania. Let's slow down and talk about how this actually worked, because understanding the mechanics helps us see how rational people made irrational decisions. When a company goes public, it sells shares to investors through an initial public offering or IPO. Investment banks help with this process. They analyze the company, set an initial price, or market the shares to institutional investors, and then the stock begins trading on an exchange like NASDAQ. Normally, banks try to price an IPO carefully. They want it to be successful, but not too successful. A stock that doubles on the first day means the company left money on the table. Selling shares too cheaply. But in the late 90s, that calculation changed. A stock that soared on opening day created excitement. It generated headlines. It made investors eager to buy the next IPO from that bank. So banks started intentionally underpricing internet IPOs, knowing that the first day pot would create momentum. This created a self-reinforcing cycle. Investors wanted into IPOs because stocks always seemed to jump. Banks could sell shares easily because demand was so high. Companies could raise enormous amounts of money because investors weren't worried about valuations. And the rising prices convinced even skeptical people that maybe this was real, maybe the old rules really had changed. Another factor was the rise of online trading. Companies like E-Trade and Ameritrade made it possible for ordinary people to buy and sell stocks from their home computers quickly and cheaply. Day trading became a phenomenon. People quit their jobs to trade full time. Chat rooms and message boards filled with stock tips and get rich stories. The media played its role too. Financial news channels needed content, needed excitement. A stock that doubled in a day was a great story. A 25-year-old entrepreneur who became a billionaire was a great story. The narrative took hold. We were living through a once-in-a-lifetime transformation, and anyone smart enough to recognize it could achieve wealth beyond their dreams. The psychology takes hold. There's a concept in investing called FOMO, fear of missing out. It's a powerful emotion, and it became the dominant force in the late 90s. Imagine you're an investor in 1998. You've been cautious. You've stuck with blue chip stocks, bonds, maybe some mutual funds. Your portfolio has done fine, growing maybe 10 or 15% a year. You feel responsible and prudent. Then you talk to your neighbor. He's been buying internet stocks. His portfolio is up 200% this year, 200%. Or you go to a party and everyone is talking about Amazon, about Yahoo, about companies you've barely heard of that have made people substantial money. Or worse, you go to work and the younger employees are comparing their portfolios. They're making more from their stock gains than from their salaries. They're planning early retirement. They look at you with something like pity, like you're the person who doesn't understand what's happening, who's going to be left behind. This is when doubt creeps in. Maybe you're wrong. Maybe the old rules really don't apply anymore. Maybe this time really is different. And yet that phrase, this time is different, might be the 4 most expensive words in investing history, because here's what people were telling themselves in the late 90s. The internet is revolutionary. Therefore, internet companies will be successful. The economy is changing. Therefore, the old ways of valuing businesses are obsolete. Technology is advancing. Therefore, these high valuations are justified. Each of these statements contains a truth wrapped in a fallacy. Yes, the internet was revolutionary, but not every internet company would succeed. Yes, the economy was changing, But the fundamental logic of business, you need to eventually make more money than you spent. That wasn't changing. Yes, technology was advancing, but that didn't make any price reasonable. Smart people convinced themselves of unreasonable things. Analysts created new metrics. Instead of earnings per share, they talked about eyeballs, about page views, about customer acquisition costs. They created models showing that if a company just kept growing at its current rate for 5 or 10 years, it would eventually justify today's price. They forgot to ask, what if the growth slows? What if competitors emerge? What if customers don't come back? What if the business model doesn't actually work? The stories that seemed real. Let's talk about a few specific companies because their stories capture different aspects of the bubble. Amazon, founded by Jeff Bezos in 1994, started by selling books online. The vision was a compelling bookstore with unlimited shelf space, lower prices than physical stores, and the convenience of home delivery. By 1999, Amazon stock had risen so much that the company was worth more than many traditional retailers combined, despite losing money every quarter. Bears, the skeptics, pointed out that Amazon was burning through cash, that it wasn't clear if the company would ever be profitable, that maybe people wouldn't want to buy things they couldn't see and touch. Bulls, the believers, argued that Amazon was building something unprecedented, that short-term losses were the price of long-term dominance, that Bezos was a genius who deserved faith. History would eventually prove the bulls right about Amazon, but that wasn't obvious at the time. And the fact that Amazon succeeded doesn't validate the price investors paid in 1999. These company stock would eventually fall more than 90% before beginning its long climb to genuine value. Then there were companies like Pets.com, which sold pet supplies online. The company had a cute sock puppet mascot. It advertised heavily, including a Super Bowl commercial. It seemed fun and friendly and modern, but the business made no sense. Pet food is heavy and cheap. Shipping it to individual homes costs more than the profit margin on the product. The company was losing money on every sale and had no clear path to profitability. In February 2000, Pets.com went public at $11 per share. By November of that year, the company shut down completely. The entire journey from IPO to bankruptcy took 9 months. Or consider a company like Webvan, which promised to deliver groceries to your home. The vision was attractive, especially to busy professionals. Order online and fresh food would arrive at your door within a 30-minute window. The company raised more than $800 million from investors. It built massive automated warehouses. It bought a fleet of trucks, but the economics didn't work. Delivering groceries to individual homes is expensive. Profit margins in the grocery business are already thin. Webvan was spending enormous amounts on infrastructure and operations while trying to offer prices competitive with supermarkets. The math simply didn't add up, but for a while, investors didn't care about math. The moment of maximum optimism, by early 2000, the bubble had reached extraordinary proportions. The NASDAQ Composite Index, which included many technology stocks, had risen from around 500 in 1995 to over 5,000, a tenfold increase in 5 years. Companies were going public with no revenue at all. Business plans that would have been laughed out of a bank a few years earlier were receiving hundreds of millions in funding. Executives were appearing on magazine covers. Books about internet millionaires filled bookstore shelves. The financial press began running on articles questioning whether the market could sustain these valuations. But for every skeptical piece, there were 5 optimistic ones. Many analysts argued that we were in a new paradigm. The old metrics were obsolete. Anyone who didn't understand this was simply too old or too traditional to grasp the transformation underway. Even Alan Greenspan, the Federal Reserve chairman, who had famously warned about irrational exuberance in the market back in December of 1996, seemed uncertain about whether the new economy justified higher valuations. Some economists argued that productivity gains from technology meant that growth could continue indefinitely without inflation. Venture capital firms were raising enormous funds. Investment banks were competing fiercely to underwrite IPOs. Business schools were teaching case studies about internet companies. Everything seemed to confirm that this was real, that this was the future, that this was your chance to be part of it. But beneath the surface, the foundation was beginning to crack. The cracks appeared. The first signs of trouble came in early 2000, though few people wanted to notice them at the time. Some internet companies began missing revenue projections when this happened. Their stocks would fall sharply, sometimes losing half their value in a day. Analysts would reassure investors that this was just a bump, that the long-term story remained intact. But each disappointment planted a seed of doubt. A few companies began running out of money entirely. They would announce layoffs or sudden shutdowns or desperate mergers. Again, these were dismissed as isolated failures. The weak companies were being weeded out. People said this was healthy, the strong would survive, but the weak companies were running out of money because they couldn't raise more capital. And they couldn't raise more capital because investors were starting to ask uncomfortable questions. Questions like, when will you be profitable? How do you make money? What happens if growth slows? In March 2000, the NASDAQ reached its peak, closing above 5,000. Then without any single dramatic event, it began to decline, slowly at first, then faster. Some investors saw this as a buying opportunity. Stocks were on sale. This was your chance to get in cheaper. But the decline continued. Week after week, month after month, the market kept falling. And as it fell, the psychology began to reverse. The unraveling, what happened next, wasn't a sudden crash like 1987. It was slower, more grinding, more relentless, like watching a sandcastle dissolve as the tide comes in. Companies that had seemed invincible began to struggle. They announced they were running low on cash. They cut staff. They closed offices. They abandoned expansion plans. Some simply shut down overnight, sending employees home with no warning. The public markets stopped rewarding internet companies. New IPOs were canceled or postponed. Companies that had planned to go public and raise capital found themselves trapped. They couldn't access the public markets, and private investors were no longer interested in funding money-losing operations. This created a liquidity crisis. Companies that had been burning through millions of dollars per month, confident they could always raise more, suddenly found the money had dried up. And when you're losing money on every sale, Running out of cash means running out of business. The layoffs began in earnest. Thousands of people, many of them young, many of them holding stock options that were now worthless, found themselves unemployed. Office buildings in Silicon Valley and Seattle and Austin went dark. The servers were unplugged. The furniture was sold. The dreams evaporated. For investors who had bought near the peak, the losses were devastating. Someone who had put $10,000 into an internet stock fund in March 2000 might have watched it fall to $2,000 by 2002, an 80% loss, years of savings gone. And it wasn't just day traders and amateurs who lost money. Pension funds had invested in these companies. Mutual funds had loaded up on tech stocks. Even conservative investors had been told they needed some exposure to the new economy. The damage was widespread. What broke exactly? Let's step back and ask the fundamental question: what actually broke? Why did the bubble burst when it did? Several factors converged. First, interest rates began to rise. The Federal Reserve, concerned about potential inflation, raised its benchmark rate several times in 1999 and 2000. Higher interest rates make future earnings less valuable in today's terms. For companies that weren't expected to be profitable for years, this was particularly damaging. Second, the pipeline of new capital dried up. As long as the new investors kept arriving, eager to buy into the internet dream, companies could keep raising money and stock prices could keep rising. But eventually, you run out of new buyers. The market became saturated with internet stocks, and supply overwhelmed demand. Third, reality caught up with fantasy. Some companies began reporting actual results that showed just how far away profitability really was. Analysts who had been optimistic started downgrading stocks. The narrative began to shift from profits don't matter back to actually profits do matter. Fourth, there was a psychological tipping point once the market started falling, once a few high-profile companies failed. The fear of missing out turned into the fear of losing everything. Investors who had been eager buyers became desperate sellers. Momentum, which had driven prices up, now drove them down. And perhaps most importantly, people began to realize that many of these businesses simply didn't work as businesses. The unit economics, as they say, didn't make sense. You can't lose money on every transaction and make it up in volume. You can't spend $500 to acquire a customer who generates $50 in lifetime value. You can't ignore basic arithmetic forever. The internet was real. The technology was transformative, but that didn't mean every company built around it deserved to exist, much less deserved a billion-dollar valuation, the aftermath. By 2002, the NASDAQ had fallen to around 1,200, down more than 75% from its peak. Hundreds of internet companies had failed. Trillions of dollars in paper wealth had vanished. The damage rippled through the economy. The technology sector shed jobs. Venture capital firms became much more cautious. Investment banks that had made fortunes underwriting IPOs saw that business evaporate. Even companies that survived, even companies that would eventually thrive, saw their stocks languish for years. Amazon, which we mentioned earlier, fell from over $100 per share to less than $6. The company survived because it had raised enough capital during the boom years to weather the bust. But shareholders who held on suffered years of losses before the stock recovered. Some people left the technology industry entirely, disillusioned by the boom and bust. Others learned lessons and eventually built the next generation of successful internet companies. Google, which went public in 2004, was more cautious, more focused on actual revenue and profit. Facebook, founded in the aftermath of the bubble, took its time going public and built a real business model first. The regulatory response was mixed. There were investigations into whether analysts had misled investors, whether investment banks had manipulated IPOs. Some reforms were made. But for the most part, the bubble was seen as a market failure, not a failure of regulation. People had made bad decisions and they had paid the price. For the American economy as a whole, the damage was significant but not catastrophic. The stock market crash contributed to a recession in 2001. Unemployment rose, but the economy eventually recovered, helped by lower interest rates and, unfortunately, by another bubble that would eventually form in housing. What investors should learn. If you're listening to this, if you're thinking about your own investments, what should you take from this story? Not as a list to memorize, but as ideas to let settle into your thinking. First, understand that new technology doesn't automatically create good investments. The internet changed the world, but most internet companies failed. The winners were real and spectacular, but they were outnumbered by the losers. When you hear about the next revolutionary technology, whether it's artificial intelligence or blockchain or something that hasn't been invented yet, remember that transformation and profitability are different things. Second, recognize that price matters. It's not enough for a company to be good or innovative or exciting. You need to buy it at a price that makes sense relative to the value it will create over time. Overpaying for a great company is still a mistake. Amazon was a great company in 2000, but its stock was priced as if it had already achieved what it would only accomplish a decade later. Third, be deeply skeptical when you hear that old rules no longer apply. Every bubble in history has featured people claiming that this time is different, that traditional metrics are obsolete, that anyone who doesn't understand this is hopelessly behind the times. These claims are seductive, especially when prices are rising and everyone around you is getting rich. But business fundamentals don't change as fast as we'd like to think. Fourth, understand your own psychology. FOMO is real and powerful. The fear of being left out can override logic and discipline. But markets reward patience, not panic. The person who sits quietly through a bubble, who lets others get rich on paper while they stick to their principles, that person often ends up ahead in the long run. Not always, but often enough that patience is a strategy worth considering. Fifth, diversification matters. If you had all your money in internet stocks in 2000, you suffered catastrophic losses. If you had a balanced portfolio with stocks, bonds, and different sectors, you still lost money, but not as much, and you recovered faster. Concentration can make you rich quickly, but it can also destroy you. Diversification is often boring, but boring has its virtues. Sixth, understand what you own. If you can't explain how a company makes money, if you don't understand its business model if you're investing based on hype or hope or what someone said in a chat room. You're gambling, not investing. There's nothing wrong with gambling if you know that's what you're doing and you can afford to lose, but don't confuse it with prudent wealth management. And finally, remember that markets are cyclical. Booms turn to busts, turn to recoveries, turn to booms again. The dot-com bubble was not the first mania in history, and it wasn't the last. There will be others. Maybe you'll live through several more in your investing lifetime. The question isn't whether bubbles will form, but whether you'll recognize them and whether you'll have the discipline to act on what you know, even when everyone around you seems to be getting rich. Closing thoughts. It's been more than 2 decades now since the peak of the dot-com bubble. An entire generation of investors has entered the market since then. People who didn't experience those years, who only know the internet as mature and essential. The companies that survived that era, the Amazons and the Googles and eventually the Facebooks and Netflixes, have become some of the largest and most valuable corporations in human history. The skeptics were wrong about the internet not mattering. It mattered enormously. But the optimists of 1999 were also wrong. They were wrong about timing, about valuations, about which companies would win, about how quickly the transformation would happen. They were right about the direction, but wrong about almost everything else. And in markets, being wrong about price and timing can be just as costly as it being wrong about direction. As you think about your own portfolio, as you make decisions about what to buy or sell or hold, maybe carry this story with you, not as a source of fear or cynicism, but as a reminder of how markets work, how psychology works, how easy it is for smart people to get swept up in a narrative. The future will bring new technologies, new opportunities, new stories about how everything is changing. Some of those stories will be true. The challenge is to distinguish between what's real and what's hype, between what's valuable and what's overpriced, between being early and being wrong. But you don't have to figure all of this out tonight. You don't have to make any decisions right now. The markets will be there tomorrow and the day after and the year after. One of the advantages of being a long-term investor is that you have time. You can be patient. You can wait for clarity. You can let others chase the shiny objects while you focus on what's real and enduring. So let your mind rest now. Let the story settle. Think about risk and reward, about fear and greed, about the difference between a good company and a good investment. Think about how you want to approach your own financial future, not with anxiety or urgency, but with calm deliberation. The night is quiet, the markets are closed. Tomorrow will bring new prices, new headlines, new opportunities and risks. For now, you can let it all go. Breathe slowly. Let your thoughts drift. Trust that the lessons of history learned slowly and carefully will be there when you need them. The dot-com bubble rose and fell. The internet transformed the world. Investors learned or failed to learn, or learned and then forgot when the next bubble came along. The story continues, as it always does, in cycles and waves, in manias and recoveries, in human hope and human folly. But you can step back from all of it, at least for tonight. You can remember that wealth is built slowly, that patience is a virtue, that understanding matters more than excitement. You can close your eyes and know that whatever the market does tomorrow, you'll face it with a little more wisdom, a little more perspective, a little more calm. Rest well. The future will wait for you.